Palisade Radio is brought to you by First Majestic Silver Corp., one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. On the line with us today is Ronni Stöferle. He's a new guest here to talk to us about the Austrian School of Economics. Ronni, welcome to the show.
Hi, Colin. Thanks for inviting me.
Yeah, absolutely, and glad to have you here. The ideas you'll discuss with us today are also available in your new book, which is coming out very shortly in English, called The Austrian School for Investors. Just so everybody knows who's listening, you can visit the site to pre-order the book at austrian-school.com. Ronni is also the author of the annual In Gold We Trust report, which a lot of our listeners have probably encountered in the past. Ronni, I want to first ask you why the Austrian school is so important today, even though it is such an old school of thought.
I think the main reason is that we're not in a cyclical crisis, but in a systemic crisis. And Keynesian and especially monetarists, they don't care and they don't talk about our monetary system and its consequences. However, the Austrian School of Economics really focuses on the root causes of the problems that we're having. And from my point of view, August 1971, when Nixon ended the Bretton Woods agreements, our monetary system, since then our monetary system is in an entirely new age. And I think we're seeing the consequences of this monetary experiment at the moment. And therefore, I think the Austrian school not only gives the right answers, it's also asking the right questions. And I think we have to talk about our monetary system. We have to talk about the consequences of inflation. We have to talk about the debt situation and so on, that are all based on our fiat money currency system.
I want to talk about a theory or what you're comparing to deflation versus inflation. You're calling it monetary tectonics. And this is very important for listeners of our show who are invested in gold and gold stocks, because it feels like there's this battle going on between deflation and inflation. On the one hand, you have the commodity prices over the last few years, which have been going down quite sharply. But on the other hand, everything else seems expensive. And as it's getting more expensive, such as artwork, real estate, U.S. stocks, what's going on from your perspective that's driving this monetary tectonics back and forth?
Yeah, monetary tectonics just is an image to show this interplay between the forces of inflation and deflation. And those forces are pushing against each other with an enormous amount of pressure. On the surface, it seems that everything is fine, but below the surface, there's enormous pressure building up. So what we're seeing since 2008 is that we kind of left this exponential function. Just have a look at the total credit market debt since 1971. We're on an exponential curve. However, in 2008, we have left this exponential curve. So we're not able to create enough credit anymore. This is the reason why the central banks all over the globe had to step in. We have seen, I think, basically every major central bank introduce something like QE, or as the Japanese call it, QQE, so quantitative and qualitative easing. We're seeing zero interest rate policy or negative interest rate policy, more or less all over the globe. So those are the consequences of the fact that we have left this exponential function of credit creation. From my point of view and from the Austrian standpoint, inflation is an increase in the money supply. Rising prices is only a consequence of monetary debasement. So based on Murray Rothbard, for example, he said that first of all, there's monetary inflation, Then there's asset price inflation, and the final stage will be consumer price inflation. Now, what you mentioned before is we already see massive monetary inflation. We're seeing asset price inflation. Just have a look at real estate markets, stock indices, art markets, and so on. But we do not see any price inflation yet. And this is what central bankers want to achieve. From their point of view, monetary stability means inflation at 2% every year. So as we're seeing disinflationary or deflationary pressure coming out, especially out of China, and therefore falling commodity prices, especially energy prices, but also industrial commodities. Based on that, we're seeing massive deflationary consequences that central bankers all over the globe are fighting at the moment. But from my point of view, in 2016, we will see some inflation surprises just because of the base effect. As soon as oil prices do not collapse further, we will see just to the statistical base effect significantly rising inflation rates, so up to 1.5, 1.6% in spring 2016 in the US. So we will see rising inflation rates. However, from my point of view, I'm absolutely certain that some sort of a stagflationary environment at the moment is probably the most favored quote unquote solution of the problem. And therefore, I think that stagflation or even rising inflation rates is definitely the pain trade for every investor, especially institutional investors that are massively overweight fixed income, of course.
Why and how is the order of inflation dictated? How does the Austrian School of Economics explain why you move from monetary inflation to asset price inflation and ultimately to the consumer price inflation?
Well, the Austrian School, or Mary Rothbard, said that the definition of money is the general medium of exchange, the thing that all other goods and services are traded for, the final payment for such goods on the market. It's as easy as that. So if you're debasing money or the monetary base, or inflate the monetary base, it's pretty obvious that there will be consequences, but those consequences are not neutral. I think this is very important. The Austrian school emphasizes the so-called Cantillon effect, meaning that there are people or institutions profiting from inflation, and other ones are suffering from inflation. So from my point of view, those people really understanding the monetary system, those are the ones that profit from monetary inflation, and those are the ones that can hedge this monetary inflation. Those people are investing, in real assets, of course, precious metals, but first and foremost, real estate, but also art, equities, and so on. And those people that cannot or do not really understand the dynamics of inflation, those people suffer from inflation, and those are the ones that typically don't buy real estate or expensive Picasso paintings. So those are the people that suffer when price inflation finally hits the market. I think that what you said before, those numbers that are calculated by government statistics, they've got nothing to do with real life. So we all know shadow stats, for example. We know how the statistics work, that it should be significantly higher. But the Austrian school says that it's always extremely subjective. So my basket is definitely different than the spending behavior of my parents or my grandparents, for example. So it's pure nonsense from an Austrian point of view to calculate a price level and based on that certain inflation numbers. However, we have to care about those numbers because this is what central bankers are following very closely. So Mr. Draghi and Mrs. Yellen are looking at inflation numbers. They're seeing they're way below the threshold at 2%. So they have to step in. They have to introduce QE. They have to stay further behind the curve, etc. And this is the reason why, although I've got this Austrian view, I'm still following the official inflation numbers because nowadays, I mean, it's really sad. The whole financial market participants are discussing the Fed rate hike for years now. And the big question is now if they start hiking in December or later, and we're talking about 25 basis points. And this already shows you how dependent and addicted the whole system is to cheap liquidity and cheap money. In a more healthy environment, 25 basis points would be ridiculous. Nobody would talk about that. But that already shows you that we're some sort of in the what we call the Keynesian end game. So from my point of view, understanding inflation, the dynamics of inflation is crucial for investors going forward. And we had some really interesting charts in our last gold report showing the inflation dynamics. So inflation can happen very fast. In the 1970s, it rose from 2% up to 15% within 2 years. We should not forget that in 2011 in the US, we had on a year-on-year basis inflation rates at 4.5%. So I'm not talking about hyperinflation, but higher inflation will happen in 2016. And this is something that most investors are absolutely not prepared for.
It sounds to me like what you're saying is that once the inflation picks up, it moves faster than the Fed can react or the central banks can react to reel it back in. What do you expect if the inflation starts to move up to 5, 10, 15% that the central banks of the world will do? Are they going to reverse course and do everything they can to create a deflation situation?
Well, they definitely are way behind the curve. I'm not sure what they will do, but I'm sure that they will act too late because they are data dependent and stuff. But most of their data is looking backwards and not into the future. So I don't think that the models that the central bankers are working with are accurate. In fact, the Austrian school says that forecasting is basically impossible. What you can do is that it seems sensible to take investment decisions that are as independent as possible from future developments, but cover the entire range of possible scenarios. So there's a great quote by Roland Bader, and he said, 1/3 of one's investments should be placed as if everything was right with the world. 1/3 should be invested cautiously and very conservatively, and 1/3 as if red alarm had been sounded. And I think that's a very, very, very good strategy going forward. We have to say that those are all monetary experiments, and nobody, no economist, no politician, no central banker knows how this all is going to work out. From my point of view, on the last page of the book, there will be inflation, I'm absolutely sure. But of course, the deflationary pressure, especially coming out from China, is enormous at the moment. And for me, gold at the moment is very much of a dollar story. So having a look at gold in different currencies, emerging market currencies, but also the euro, for example, you can see that gold is doing very, very well these days. However, we're seeing enormous dollar strength. And as long as the dollar continues to rally, gold will have a tough time in dollar terms. On the other hand, I tweeted the chart in the morning showing that as soon as the Fed started hiking interest rates, the dollar got weaker in history. So that's very classical buy the rumor, sell the fact. So perhaps if the Fed raises 25 basis points in December, this might be the end of the dollar rally, but also the beginning of a new bull market in gold. I think that's a very accurate scenario.
All right, final question for you. Looking forward 10, 15, 20 years, even if the dollar does break down and gold goes to $5,000 or $10,000 an ounce, what is your ultimate prediction? Will the dollar last? It certainly is backed at this point in some way by the oil trade, so there is something propping it up there. Do you think that it ultimately loses and another currency takes over, or do you think it has a chance of sticking around?
Wow, it's a tough question. I would say that the dollar will be around much longer than the euro. If the dollar will be around in 20 years, and especially what the purchasing power of the dollar will be then, I'm not sure. I mean, there's so much going on these days, especially in geopolitics. However, I think that in 20 years, the purchasing power of gold will be significantly higher than the purchasing power of any fiat currency. So that makes me sleep very, very well with my investments, with the fund that I'm managing, with mining stocks especially. I'm really, really confident. It's not a sprint; it's a marathon, and I think that. In this, you probably are familiar with the book Currency Wars by Jim Ricketts, who is also on our advisory board. Currency wars are happening these days. The US is at the moment not participating, but sooner or later, that the Fed will also be concerned about the strength in the dollar, because that causes problems on a global scale. So they will start joining the currency wars again, and I think at the end, gold will be the winner of this competitive devaluation.
Fantastic. Well, Ronnie, thanks so much for coming on the show. Just another reminder to our listeners, his new book, The Austrian School for Investors, can be found at austrian-school.com. Ronnie, any other points to note to our listeners?
No, the book will also be available on Amazon, of course. You can subscribe for our research on our webpage. It's incrementum.li. We're publishing the annual Gold We Trust report. We're publishing chart books about gold, silver, monetary tectonics, and so on. And we're also publishing our quarterly advisory board discussion featuring Jim Ricketts, for example.
All right, Ronnie, a pleasure having you on. Thanks so much.
Thank you very much, Colin, and all the best to you and all your listeners. Thank you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?